Hello, and thank you for joining us for our weekly investment brief that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So this week, I want to spend some time cutting through what I think are a few conflicting signals in the economic data. The July employment report was unquestionably weak, and that's gotten a lot of attention. But when we broaden the lens beyond employment, we're actually seeing signs that economic momentum may be improving. And that's showing up in some of the economic data, and it's showing up very clearly in corporate earnings. And it's showing up in the market trend also. Now, the wrinkle is that stronger growth isn't an unambiguously positive development. It potentially makes the inflation picture more complicated, and it gives the Fed potentially less flexibility. So, today I want to talk through both sides of that equation. So let's start with markets here. And last week was generally positive across risk assets, and that was helped by a more favorable macro backdrop. Bond yields eased, the dollar weakened, and commodities were relatively well behaved. Those are all variables that have been important to the market this year. And I think that's worth remembering because this bull market isn't operating in a vacuum. Earnings have been excellent, but interest rates, inflation, and the dollar can either amplify or offset those fundamentals. Last week, at least, the macro variables were generally working in the market's favor. Now, let's get to the economic data because this is where the story gets a little more interesting. The July payroll report was weak. There's really no reason to sugarcoat that headline. Job creation disappointed, and importantly, prior months were revised lower as well. So the labor market has clearly cooled from where it was. But I think we need to distinguish between a labor market that's slowing and an economy that's contracting. Employment tends to get most of the attention because it's tangible and politically important, but it's also only one part of the economic mosaic. And here's one of the unusual aspects of the current labor market. Despite weaker job creation, unemployment has actually been falling. Looking at the unemployment rate, that is. Now, normally we'd associate that with a strengthening labor market, but in this case, some of the decline reflects a shrinking labor force. So there are really two things happening simultaneously. Businesses are adding fewer workers, but the supply of available workers isn't growing very quickly either. And that's important because it means we shouldn't automatically interpret slower payroll growth as evidence that demand is collapsing. It may increasingly reflect an economy in which the supply of labor itself is becoming constrained. And when we move beyond the labor market, the economic picture actually looks considerably better. We're seeing improvement across several measures of economic activity. Business surveys have firmed, measures of economic momentum have improved, and consumer activity has remained reasonably resilient. So the message isn't that the jobs report doesn't matter, it does. The message is simply that one weak data series shouldn't become our entire economic thesis. The broader collection of data looks much more consistent with an economy that's still growing and potentially gaining some momentum, and more so than one that's rolling over into a recession. And corporate America is giving us another pretty compelling piece of evidence. Second quarter earnings have been exceptional, with most of the S&P 500 having now reported 86% of companies have beaten their earnings expectations, and 76% have beaten revenue expectations. Blended earnings growth has climbed to more than 50%. Now, some of that growth is concentrated among the very largest companies, but even stripping out some of those outsized contributors, earnings growth remains quite healthy. And that's difficult to reconcile with the idea that the economy is deteriorating rapidly. Ultimately, earnings are the bridge between the economy and the stock market. And right now, that bridge remains very strong. Now, of course, strong earnings don't automatically make stocks cheap. One of the interesting developments this year is that earnings have risen quickly enough that valuations haven't needed to expand for stocks to rally. Now, that's healthy. But let's also be clear, stocks aren't cheap. The PE ratio on the S&P 500 remains around 25 times earnings, which is above its longer-term averages. So this is a market where fundamentals are doing a lot of the heavy lifting, but investors are also already paying a healthy price for those fundamentals. And that's where expectations do become important. And that brings us to inflation. One of the challenges for the Fed is that today's inflation problem increasingly appears to have a supply component. Tariffs, labor availability, and other supply constraints can push prices higher without necessarily reflecting excessive consumer demand. And that's an important distinction. Monetary policy is very good at influencing demand. The Fed can make borrowing more expensive, slow investment, and reduce consumption. What it cannot do is manufacture workers, eliminate tariffs, or increase productive capacity overnight. So, if inflation remains sticky because of supply constraints, the Fed's job becomes considerably more complicated. Now, one thing here on this slide is it's bringing us to the Fed. And now markets are currently wrestling with what the Fed does in September. The weak employment report that argues for easier policy, but resilient growth and sticky inflation argue for patience. And that's really the tension. The Fed can address the demand side of the economy, but easing monetary policy into an economy that's already showing signs of improving momentum, that could potentially add demand at exactly the time that supply remains constrained. And tightening policy into a sluggish job market could create economic turbulence. That's why the path forward isn't particularly straightforward. And even if the Fed does begin to tighten policy, context matters enormously. Historically, gradual tightening cycles associated with a normalization or a modest economic overheating have been very different environments for markets than rapid tightening cycles that have been associated with strong inflation or a lot of economic overheating. So we shouldn't simply ask, is the Fed hiking? We should ask, why are they hiking and how quickly do they need to do it? If the Fed can gradually normalize policy while economic growth and earnings remain healthy, that's a very different backdrop than one where they're forced to rapidly hike interest rates because inflation is running away from them. And this brings us back to something that we've been discussing for several weeks. We still think the setup for some fall volatility is there. Not necessarily because something is fundamentally wrong, but because the bar has gotten higher. Earnings expectations are high and valuations are elevated. Investors have become more optimistic, and we're entering a seasonally more challenging part of the calendar. Markets don't need bad fundamentals to experience a correction. Sometimes they simply need fundamentals that aren't quite as good as investors have already priced in. So I'd separate our intermediate term optimism from our expectations over the next few months. Importantly, none of that changes the primary market trend. The bull market remains intact. Price trends remain positive, earnings are growing, and the economic backdrop continues to support corporate profitability. And we've also seen leadership broaden beyond just a handful of mega cap growth companies at various points this year. And that's generally healthier than a market being carried indefinitely by only a few stocks. So we're not interpreting these cross currents as evidence that the bull market is ending. We're interpreting them as evidence that the bull market is maturing. And maturity shouldn't be confused with mortality. So let's bring all of this together. The labor market has unquestionably softened, and we shouldn't dismiss that signal. But the broader economic data, corporate earnings, and market trends continue to tell us that the expansion remains intact. Ironically, that resilience creates its own challenge. Stronger growth combined with supply-driven inflation, that makes the Fed's job more complicated. And meanwhile, investors are already paying relatively high valuations and expecting a lot from corporate America. So our conclusion really hasn't changed. We remain constructive, but constructive doesn't mean complacent. We think the bull market remains intact, and we also think that the combination of elevated expectations, valuations, and seasonal tendencies could produce a bumpier road over the next few months. That's not a reason to try to time the market. It's a reason to stay diversified, remain disciplined, and make sure that portfolios are built to withstand volatility when it inevitably arrives. So the backdrop remains constructive. We just shouldn't confuse constructive with uncomplicated. So that's what we have for you this week. And as always, I want to wish you a great week ahead and thank you for joining us.